In the vast realm of investment, forecasting is commonplace. From predicting market trends to assessing potential business growth, making predictions is deeply entrenched in the DNA of investment analytics. Yet Warren Buffett, one of the most esteemed investors in history, once quipped, "Predicting rain doesn't count. Building arcs does." While this adage might sound simplistic, it encapsulates a profound truth about investing that every analyst should internalize. No matter how advanced our tools, models, or analyses become, the market remains unpredictable. Countless factors influence market movements, from geopolitical events to natural disasters, technological innovations, and societal shifts. Predicting these events with absolute certainty is nearly impossible. Buffett's metaphor of predicting rain serves as a reminder that it's easy to get caught up in forecasting and speculating about the future. However, such predictions often don't lead to concrete or tangible outcomes. Instead of focusing purely on predictions, investors should prioritize actions that prepare them for potential outcomes. When Buffett mentions building arcs, he underscores the importance of preparedness. The arc represents a proactive measure to safeguard against potential threats. In the investment context, building arcs can be equated to creating diversified portfolios, having a well-thought-out risk management strategy, and investing in businesses with solid fundamentals and moats. An investment analyst should remember that while forecasting can provide valuable insights, the fundamental success metric is how well prepared the portfolio is to weather storms. This entails analyzing companies' intrinsic value, resilience in challenging market conditions, and long-term potential, rather than just speculative short-term gains. Another layer of Buffett's wisdom pertains to the human psychological pitfall of overconfidence. Analysts and investors might often feel that their predictions, based on sophisticated models and past data, are foolproof. Yet history is replete with examples where widespread consensus about market movements proved wrong. By emphasizing the importance of building arcs, Buffett cautions against placing undue faith in predictions. Instead, he promotes humility, pragmatism, and a focus on tangible actions over mere speculation. For investment analysts, Buffett's words offer a clear directive. Spend less time and energy on the endless task of prediction and more on creating robust investment strategies. This means diversification, ensuring portfolios are well diversified across sectors, geographies, and asset classes to mitigate risks. Research, digging deep into companies' fundamentals, understanding their business models, and ensuring they have competitive advantages that can withstand market upheavals. Long-term focus, avoiding the myopia of short-term gains and instead focusing on long-term value creation. In conclusion, while predictions have their place in the investment world, they shouldn't be the bedrock upon which strategies are built. Buffett's aphorism is a timeless reminder that preparation and pragmatic action triumph over mere prognostication in the unpredictable investing world. As analysts, it's imperative to heed this advice and prioritize building robust and resilient investment arcs over the elusive and often misleading task of trying to predict the rain.